Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Hi, I'm your host, Erin Allen with BMO ETFs. Welcome to today's session where we are going to be diving deep into the Nasdaq 100 index, how you can invest in it with ETFs, and how it gives you exposure to the modern economy. So this index is really going to give you access to those potential game changers, category definers, and the forward thinkers in the space. So I'm really excited to be diving into this index today and learning more about the overall exposure. Just a reminder, today we are not providing you with any advice or investment recommendations. Today's episode, just like all of our episodes, is focused on education around ETFs and around investing in the markets for investors who are looking to take charge of their own investments. With me today, I have my colleague Mark Raes, Head of Product at BMO ETFs, and our partner from Nasdaq, Mark Marex, Director of Index Research and Product Development. So I'm really excited to have you both on today. Thanks for joining me. Before we do get started, I want to give a quick reminder to check out our YouTube channel. We've been doing this for over 2 years now. There's a ton of great content that you may have missed. Please remember to subscribe and ring that bell so that you're notified when future episodes go live. All right, so today for the 1-minute update, I thought I would highlight the latest US CPI numbers. So with inflation on sort of everyone's mind, unfortunately, the print came in above the consensus forecast. So it came in at 8.3%. And this was not far off the peak that we saw in June, which was 9.1% in the US. So we did see gas prices coming down, thankfully for our tanks, which reduced some of the price pressures from other areas, but other areas were really full steam ahead. So it looks like the Fed is likely going to continue with their aggressive rate hikes. The market is pricing in another 75 beeps for September and 50 to 75 in November. So that's just something to keep in your mind. That's the inflation update for today. Definitely something to watch in your investment portfolios. So let's get into our topic today, Nasdaq 100. Mark, Marex, thank you so much for joining us. Hoping you can get us started with an overall introduction to the Nasdaq 100 index from a high level, maybe highlight some of the names that this index will give you exposure to.
Thanks, Erin. Pleasure to be here as always. Always enjoyed talking with the folks at BMO about these products. The Nasdaq 100 really is the bread and butter of the Nasdaq index business. It was launched in 1985. Believe it or not, 1 year older than I am. It's been around obviously for a very long time now, and it's one of the largest ETF ecosystems in the world, with just the biggest ETF in the US here, recently reaching $200 billion of total AUM. The index methodology, pretty straightforward. It's the top 100 non-financial companies listed on the Nasdaq exchange. Non-financial meaning we don't select banks, we don't select real estate companies and REITs and things like that, insurers. Not that there are very many large financial companies listed on Nasdaq to begin with, but that's just been the methodology from the very beginning. And that continues to be pretty consistent. It's a cap-weighted index. And we'll maybe talk about some of the exposures later on, especially with how it relates to inflation. But it is mostly an index of tech and consumer and health companies with a little bit of exposure to industrials and telecoms as well. But in our minds, when you look at what is powering economic growth in the 21st century, it is those new economy sectors that are highly digital. We had this transformation at the turn of the 21st century from a true industrial economy back in the 1900s, right? The Dow Industrial average was really, I think, a good measure of the most important companies in the US that were driving economic growth. companies like the automakers, the big oil companies, General Electric. The turn of the 21st century really heralded with the tech bubble initially, right? The excitement of the economy transitioning from industrial to technological, from analog to digital, from hardware to software. And when you look at what the biggest companies in the world are today, they are disproportionately tech or consumer companies like Amazon that basically people think about as tech when you look at what Amazon is doing to make their money. And we think of them now as basically today's version of the old diversified industrials of the 21st century. You've got these big technological conglomerates like Amazon that have a huge e-commerce business, a huge cloud services business with Amazon Web Services, movies, they're getting into health as well. Microsoft and Google similarly have, very, very dominant positions across multiple products and services. And that's really what this index is all about. It's giving you the exposure to those biggest NASDAQ listed names along with the others that follow closely behind, leaders in technology like Intel and Netflix, for example, right? They do one thing and they do it very well. So that's the type of exposure you get with this index.
Perfect. Yeah, that's a great high-level view there. And I think as Canadian investors with a lot of financials and not a lot of tech in our portfolios here at home, this makes for a nice complement to some of those more home-biased portfolios. All right, Mark, Raes, what should investors expect when it comes to volatility from the Nasdaq 100? With it, largely exposed to these higher growth names, what does that volatility look like relative to other well-known U.S. benchmarks like the S&P 500, for example?
Sure. Thanks, Erin, and thanks everyone for tuning in. Appreciate you listening in to hear the story this week. If we look at the volatility, I think in our minds we think of Nasdaq as being a more growth-oriented index, which it certainly has shown in returns over the years. And in our minds, we probably make a connection to volatility, thinking that it's going to be much more volatile than some of the other leading indexes out there. But as you can see on the chart, if you look, a little more longer term, it hasn't been. Now, there's been certain market conditions that lend to more volatility compared to others. But if you look longer term, you're actually getting a pretty consistent volatility range. Now, if you look at this year, where of course the big story has been inflation and therefore growth-oriented companies taking it on the chin a little bit harder than more cash up front companies, you see more volatility in the Nasdaq this year compared to S&P 500. So you got to think about market conditions a little bit, but that's always going to be situational as a long-term investment in your portfolio. Looking at the volatility here, we are seeing a pretty consistent vol level with what else is out there. So that's great news for Nasdaq investors.
Yeah, I was personally surprised when I saw that chart. I thought it would have had a whole lot more volatility. But sticking with you, Mark, how has the index performed relative to the S&P 500 over time? You mentioned there's certain market conditions that it may underperform in. So can you speak to that a little bit more?
Well, I think this is the big story for people watching and listening in is to see that long-term performance and realize how the Nasdaq has really done very well. If we look post 2008 in a generally growth-oriented market where monetary policy has obviously been very supportive of market growth, and companies have been able to invest in research and grow over time. You see that reflected in the performance of the Nasdaq 100. I know Mark has some great points that I'll get to about the underlying within the index, so I won't steal his thunder. But that's really the story when you look at the performance, is in that growth-oriented market, you see a real outperformance. And that's something that when I look at that chart, tells me that Nasdaq 100 is quite a valuable holding to have in your portfolio. Don't think that all exposures are the same, but realize what you're getting in that exposure relative to other things, and of course relative to what you already have in your portfolio. Your example off the top was a great one about home bias portfolios that maybe are heavy on, let's say, Canadian banks. This is the type of exposure that pairs really well with that. Thanks.
For sure. All right, and Mark, I'm turning it back to you. It's definitely been a challenging year for all areas of the market this year, but for sure for Nasdaq too. But can you talk about some of the earnings highlights that came out more recently and some of the larger weights in the Nasdaq 100?
Sure, Erin. So these are these are a couple headlines from earnings in the second quarter, which are finally starting to wind down now. And when these earnings started coming out, what you saw with the Nasdaq 100 was actually it started rallying even before the earnings came out. Most of these were in July. The index sort of bottomed for the year in mid-June and then staged a really impressive rally for about 2 months. Largely, I think, off of the back of investors realizing that the earnings strength, the fundamental strength of the backbone of this index, those biggest companies that we talked about on the first slide, continues to be really strong. And it's for a couple of reasons, right? One is that we talked about how they are dominant in multiple areas of business. And you'll see that Facebook is one of the companies highlighted here. Facebook is the exception out of the big companies in the Nasdaq 100, at least out of the big five, because they're sort of all in on advertising. Advertising is 97, 98% of their revenue, and they're all in on Meta versus this 10-year, really CapEx intensive project where they're trying to build a whole new business that's not going to have any revenue, any profits for a very long time. So the fact that advertising, when you think about an economic slowdown, advertising is very sensitive to that when you get a slowdown in sales and consumer demand. So it's not surprising to me that Facebook reported a drop in revenue for the first time in its history. And it's not surprising to me that that stock has done worse by far than any of the other sort of top 5, top 6 names in the index, again, because of this uncertainty around this really expensive project that they're undertaking with Metaverse for the next 10 years. When you look at the other major names like Microsoft, like Apple, Amazon, and Alphabet, aka Google, they have held up tremendously well. And it's for the most part because they have built these really resilient business models that are very heavily weighted towards subscription-based revenue, aka annualized recurring revenue. And they've embedded themselves with so many customers, not just individuals, but also enterprise. Think about, any business of scale now runs its applications out in the cloud. Amazon, Microsoft, and Google are by far the top 3 largest cloud service providers. Those businesses are all growing 40, 50, 60% sequentially. And the runway on those businesses is exceedingly long. We're only about 10% of the way there. If you look at the estimates of the overall transition that's going to happen from on-prem to cloud over the coming, let's say, 5 to 10 years. So that's just an example of some of the really, really strong secular, long-term fundamental drivers that underpin the really biggest names in this index, excluding Facebook. Tesla's on here too. Tesla's maybe not as diversified right now, but they've just got such a huge lead within EVs that they again are more insulated, I think, than Facebook, which competes with a lot of other firms in that advertising domain. So I think for the core of the index, the earnings really underlined, the strength that continues to exist despite maybe some slowdowns in the economy in certain sectors.
Great. And looking at earnings, how is that translating into how valuations are looking right now? Oh, this was an interesting chart that you provided.
Yeah, so we published some research a couple months ago. One of them was one of the main points was looking at, okay, what's the forecast for the index if you had to forecast an extended period of high inflation and high rates? How is the index positioned to deal with that, right? And one of the main points was from a debt level, right, from an overall indebtedness level and from a debt servicing level, interest payments every quarter, it's extremely competitive versus the broader market as measured by the S&P. Anywhere from 30 to 70% less exposed in terms of the debt burden, depending on what measure you use. And to me, that's a huge competitive advantage. And I think people started to realize in May and June when the index bottomed that, hey, wait a second, we're at 10 and 15-year we're below the 10 and 15-year trailing averages for a lot of these valuation ratios. The index's earnings power is way stronger than it was back then, 10 or 15 years ago. Are these low valuations relative to history justified? And our position is that no, not really. And this shows you, any way you look at it, PE, price to sales, price to cash flow, EV to EBITDA, they all kind of tell you that recent valuations have been, if not downright average, then cheaper than average on a long trend. Look at the PE especially. 20 years ago, at the end of 2001, this index was at a PE of over 200. We didn't even peak at 40 when the market got really a little bit ahead of itself post-COVID in 2020, 2021. We didn't even peak at 40. So it's a completely different story in terms of, did valuations get really stretched? Yeah, maybe in some cases they did, but they did not at an index level approach anything near what we saw, when you had a tech bubble 20 years ago.
Interesting. So potentially a good entry point here. Now, of course, we're in a rising rate environment. We spoke about the high inflation. How are these variables going to impact these more growth-focused stocks in the Nasdaq 100? And what are some things that investors should be considering when it comes to the market conditions?
Yeah, so I mean, let's start off with the kind of simple premise, right? Which is that every discounted cash flow model, every valuation model that's out there, one of the single biggest inputs is the interest rate, the discount rate on future cash flow. So in many cases, this was a valuation correction driven by Excel models of analysts saying, wait a second, interest rates are now going to be 100, 200, 300 bips higher than we had modeled for a long time for potentially several years. And so that discounts your future earnings, your future cash flows to a much lower extent, to a much lower rate than previously, right? So intuitively, you would think, yes, the more of your earnings power that is concentrated out in the future, 5, 10, 15 years in the future, the more of a hit today you're going to take when rates go up. So what this chart here is showing is, what happened the last time rates went up by a similar amount. You can see the blue line, it was like a very gradual stairway up from almost 0 to about 2.5%. This happened over the course of several years, peaking at the end of 2018. In 4Q 2018, the Nasdaq 100 dropped 23% from peak to trough. That was a true bear market, and that went on for just one quarter because people thought, wait a second, maybe the Fed's going too far with this, and they're going to overdo it, and things are going to slow down too much, and the index, took a hit, along with the S&P, along with the rest of the U.S. equity market. The Fed ended up pausing right around 2.5, and then soon started cutting after that. And you can see the dip in the NDX price in the gray, kind of a blip, almost not noticeable, but it was 23%. Which is not far off from the drawdown this year to date. This year to date, though, the Fed is raising much faster because they've fallen a little bit behind the curve. They realize the neutral rate is higher than they maybe thought. And the question, I think, for investors to figure out, as I alluded to earlier, is not whether inflation is going to get to 10%, 15, 20% and out of control. The Fed's not going to let that happen. The Fed's learned its lessons from the 1970s that they will hike and they will keep rates high until inflation gets under control into that sort of 2 to 3% range. I think the question for investors is what happens to stocks if rates get to 3 or 4 or maybe even higher, 5%, and have to stay there for a few years. And again, that goes back to the point about how much debt do you have on your balance sheet, how much your interest costs are going to go up, and what is your earnings power? Are you competitive in the sense of if the price of everything is going up, are consumers going to continue to pay for your products versus downsizing versus substituting to cheaper alternatives? And when we look at the price setting ability of many Nasdaq 100 companies for these products and services that you simply cannot live without these days, that's how ingrained they've gotten in everyday life. We think it's a very optimistic viewpoint, even if rates were to get up pretty high and stay there for a few years.
Okay, great. So these companies are table stakes. They're going to be able to pass all those costs off to us, people who need them the most. We're in trouble. All right, so let's look at the portfolio a little bit more. I liked this slide. So the next two slides, we're going to look at basically the underlying exposure. So this slide just shows basically the extreme amount of R&D investment that is going on. So walk us through this, Mark.
Yeah, so I mean, this kind of goes along with the fundamental story that we tell about the index versus the S&P, because that is, that is the large cap benchmark in the US. And, when you look at the fundamental story in very long-term terms, going back 2 decades, you see that, earnings, revenues, dividends, they're all growing considerably higher, multiples higher than the S&P 500. And that is despite the fact that nowadays you've got something like 75 to 85 for many years now in a row, companies that overlap between the two indexes. So what this slide is showing you is for one of those fundamental indicators, R&D in particular, how much does a typical Nasdaq 100 company spend? How much does a typical S&P 500 company spend? And then what are the companies in the S&P 500 that are not also in the Nasdaq 100 doing? That's the last segment, the SPX X NDX. It's about 420 companies in the S&P 500. And you look at the differential, the disparity here, and you kind of start to get the point we were making earlier about what drives out performance these days, and it's where are you exposed to the most economic growth. And disproportionately, the economic growth that's happening in the US these days is from those newer economy sectors. It's not from financials, it's not from energy, it's not from utilities, it's not from materials, chemicals, all that stuff that was really driving growth in the 21st century, the 20th century, not so much driving growth in the 21st. It's disproportionately tech, healthcare, and consumer. All those sectors rely really heavily on R&D to come up with new iterations of product and new product horizons completely, right, to grow their top and their bottom line. So when you do the math, typical NDX company spends $13 billion on average in R&D. That's almost double what the typical S&P 500 company spends. But when you strip out those overlapping companies, it's 6.5 times the amount. 6.5 times is a huge, huge gap that we see consistently happening year in and year out. When you look at it as a percentage of sales, it's not as dramatic, but it's still 10% of revenue for Nasdaq 100 companies on average reinvested back into R&D internally versus 4% for those S&P 500 companies that aren't also part of the Nasdaq 100. So it's a totally different way of, I think, running a company when you invest consistently so much in research and development to be able to do things like come up with patents and turn out new products and new services constantly versus relying on, a way of doing business that's been around for decades and is not changing.
Yeah, I think investors are increasingly wanting to get exposure to these innovative companies. And I mean, if you just look at the product launches alone over the past few years in ETFs, there's been a lot of innovation-focused solutions coming to market. So I think it's interesting this slide to show all of the exposures that you get within this diversified index. So maybe walk us through some of the themes that have the greatest exposure here.
Totally, yeah. I mean, it can be a little bit daunting for investors who are newer to ETFs to, look at, I think in the US, we just hit 3,000 actively listed and traded ETFs within the US. It could be a little daunting to look through that really, really long menu and figure out, what do I need? Do I need a cybersecurity ETF in my portfolio? Do I need a fintech or a cloud computing ETF? And in many cases, that might be the case. And a lot of what we're showing on this page here relates back to thematic indexes that we calculate in-house at Nasdaq that give you very targeted exposure to single themes that have ETFs tracking them, and they are investable. But when you look at what's in the Nasdaq 100 and you look at the number of companies in the index that appear in all of these other single theme areas, and you look at the index weights, I mean, check out AI and big data, right? 27 companies in the Nasdaq 100, 62% by index weight appear in one or more of our AI and big data indexes. We've got 3 of them. That is an astounding amount when you first think about it, but when you start to read about how, for example, Google has the single largest grouping of AI patents in the entire world, larger than even any government or university, you start to appreciate, the importance of some of these themes to those companies, and that you start to appreciate that the Nasdaq 100 really is this kind of super thematic index where just investing in the Nasdaq 100, you get a package deal, you get exposure, meaningful exposure to many of these themes sort of right off the bat.
I like that, super thematic exposure. Good. All right, Mark Raes, I'll give you a breath there, Mark M. Let's turn it over to you. Can you walk us through the options that are available to Canadian investors if they want to gain exposure to this index?
Sure, thanks, Erin. There are a number of Canadian listed ETFs on the Nasdaq 100. Of course, there are as well US listed. The advantages, as we've talked about in the past, for Canadians to hold Canadian ETF, certainly focus in on tax, estate planning, and the like. So there's clear advantages to buying a Canadian listed product. As well, within Canada, you'll get that opportunity to consider currency. So whether you want to hedge the US dollar exposure and get a return similar to just the underlying equities, or whether you want unhedged and you want the impact of the US dollar to Canadian dollar flowing through your portfolio as well. So some clear advantages to investing in Canadian products. Happy to say that BMO with our ZQQ and ZNQ ETFs are certainly a leader here in the Canadian space. There are a few other providers that have NASDAQ exposure, so there is an opportunity to look around as you see fit. But what I wanted to make sure people understood is the advantages of investing in these products via Canadian listings. So happy to see ZNQ and ZQQ doing quite well, and great options for investors.
And walk us through our covered call technology ETF, because I thought that this was the natural extension to this conversation. So how does this work in a portfolio?
Sure, this is a bit more of a focused portfolio, a bit of active selection of what's going on underneath the hood in terms of the securities, but looking to bring in a tech exposure, but then to get paid while you wait, so to speak. So what the covered call strategy allows for is to write options on those underlying holdings, typically short dated, out of the money options, where you're selling away excess upside for cash upfront premiums. So that means you're getting exposure to the stocks, you're getting some participation on the upside, but you're also earning option premiums, which sort of converts your exposure to getting more upfront cash flow as opposed to longer term gains. So for more defensive investors, for more cash flow focused investors, covered calls can make a lot of sense. ZWT, our covered call tech ETF, is one of the many options we have under covered calls, including broader market or even some other sector and thematic type covered calls. But as you say, this is a good extension of the conversation, being a tech covered call.
There you have it. All right. Before we get to our audience questions and wrap up, I just wanted to also mention that NASDAQ has an initiative that they do called Trade Talks that you can check out on YouTube or on their website, where it's just quick 2-minute snippets on what's going on in the markets and on all kinds of different topics. So we will be participating in that going forward as well, but check those out as well for sort of, I think they're 2 to 3 minutes, right, Mark? Really quick hits on what's going on in the markets. Okay, well, thank you guys both. Let's turn to our audience questions. Mark, the first one that came in is related to NASDAQ, so I'll send this one your way. Does NASDAQ 100 have exposure to crypto?
Yeah, that's a timely question, isn't it? I would say it's not a meaningful exposure. For example, we don't have Coinbase in the index because it is classified as a financial company and it will not qualify unless it's somehow reclassified to a different type. Probably the most meaningful exposure is from PayPal, which is one of the biggest index constituents, and they're doing a number of kind of things within their platform to facilitate crypto payments and crypto transactions. The other ones that come to mind would be something like an NVIDIA, which is one of the biggest semiconductor companies in the world. They're really known for their gaming processors. A lot of crypto miners like to use those processors to mine Bitcoin. And so, you would see, for example, a pickup in their revenue for some of that stuff. If there's a big crypto rally, I think people have established that type of correlation before, but not kind of traditional, direct exposure to crypto in the sense of owning like a Coinbase, for example.
Okay, perfect. Thanks for taking that one. Mark Raes, can you tell me the fee on your covered call ETFs?
Sure. They all have the same management fee at 65 basis points. MERs come in the low 70s by the time you add tax on top of that. When I think about the covered calls, I really do think of them as convenience vehicles for investors. In other words, anyone that's done option overlays or option writing on their own would know that it's a lot of work, takes a lot of time, a lot of analysis, and it's quite different than just buying a stock outright because, of course, with options, you're dealing with expiries and replacing positions. So typically with these covered call strategies, we're writing very short dated, let's call them 1 month plus options, which means, up to 12 times a year, you'd be replacing that option overlay if you were doing this on your own. So within that context, the fee, which is higher than your traditional equity exposure ETFs, actually makes a lot of sense and is a great bargain for investors because of that operational efficiency and the convenience of just buying that single ticker as opposed to having a basket of securities and continuously placing option trades.
Yeah, for sure. And I think making sure to look at that all in MER is important too, because there can be associated costs with trading options. Also, some of our competitors, they use leverage. There's costs associated with that. Rates are rising, so we got to be careful about that all-in cost. If you can't find it on the website, you can always check the ETF facts for that. Okay, the last question. Mark Raes, I'll send this to you as well. With rising rates, how will this impact fixed income, and should I be focused on equities only?
So there certainly is an impact of fixed income, and we've seen that this year being, the toughest year in fixed income markets, certainly since I've been in the industry. There's ways to adjust your fixed income exposure, because I think the purpose of having that defensive fixed income in your portfolio hasn't really changed, but you might be looking at shorter duration products so that you're a little bit less exposed to interest rates. And the other one that you can think about are inflation protected bonds. So something like our ZTIP, like ZTIP as we call it, which buys US Treasury inflation protected bonds, is a very interesting add to a fixed income portfolio, because of course the payments on those bonds are in fact adjusted for inflation, so you get a little bit of a buffer that way. So people certainly repositioning in fixed income would be what I would think about at that point. But it also affects your equity market exposure. So, the more you're oriented to higher growth names and future cash flows, Mark talked about discount cash models and the impact that interest rates have on that. That's something that you need to consider. So, cash upfront companies and companies with competitive advantages and competitive moats certainly are better able to withstand that volatility right now. So thinking about that in the context of your portfolio certainly makes a lot of sense. And maybe as a satellite, I'll throw out there global infrastructure like our ZGI ETF, where revenues are in fact tied to inflation with contracts. you tend to see that type of exposure hold up a little bit better in higher rate, higher inflationary periods. So there's things you can do. Certainly I'd encourage everyone to continue thinking long term. And you go back to one of the charts Mark showed where the PE ratio looks like it's back in a sort of normalized range. That starts to look like an opportunity as you look further forward, certainly with some volatility still in front of us in the short term.
Great, thank you. Thanks, Mark. Raes, always appreciate all your insights and expert in the product field. And Mark, Marex, you guys have been a great partner to us at Nasdaq, so definitely appreciate you both being on with me today. Thank you to everyone who tuned in this week. Next Friday, I'll be joined by our asset allocation ETF portfolio manager, Chris McCaney, as well as Steve Shepard, who is a portfolio manager on our multi-asset solution team here. So we're going to be talking a lot about current market environments, discussing inflation, currency outlooks, and so much more. But we'll also be discussing how you can position your portfolios from an asset allocation perspective. So I hope you can all join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.